Hello, everyone, and welcome to the monthly market monitor for February. My name is Michael Ballman, investment analyst here at Corporate Central Credit Union. Just a couple notes here before we get started. We are recording this, and a link will be shared out after the presentation. If you do have any questions as we're going along, please feel free to drop those in the chat or the Q&A feature. So with that being said, we'll go ahead and get started. First, we'll take a look at some employment data that came out today. Across the board, we saw some improvements to the labor market. The unemployment rate for January fell to 4.3% versus 4.4% reading in December and retreating from its peak of 4.5% back in November. Overall, the trend has been rising the past few years, but we're still at that bottom end of the 4 to 6% that's considered to be full employment. Taking a look at the U6 rate for January, which again looks at the unemployed individuals as well as those who are underemployed, either have given up looking for a job or have temporarily left the workforce. The U6 rate also declined month over month in January, down to 8% from 8.4% in December, and off its peak of 8.7% seen in November. This was the lowest level going back to July of last year. Taking a look at average weekly hours worked, we also saw an improvement here month over month, which rose up to 34.3 hours in January, up slightly from 34.2 in December. We've been running slightly below the pre-pandemic level in this metric, but still very consistent over the past year and a half. Taking a look at labor force participation, this has also ticked back up in January up to 62.5%. We've been at this rate twice recently, and this 62.5% level is the highest going back to April of last year. This is another rate that is trending again below where we were pre-pandemic, but overall still very strong and consistent levels from a labor participation standpoint. Taking a look at payrolls, in January, the labor market added a whopping 130,000 non-farm payrolls, which was well above forecasts of 70,000 and much higher from the downwardly revised 48,000 increase that was seen in December. This was the highest level since December of 2024. Gains were seen for healthcare of 82,000, social assistance at 42,000, construction with 33,000, and manufacturing at 5,000. On the other side, financial activities decreased by 22,000, and federal government decreased by 34,000 jobs, as some federal employees who had accepted a deferred resignation offer in 2025 came off of federal payrolls. Additionally, total non-farm employment growth for 2025 was revised down to a total of 181,000 increase from the originally reported number of 584,000. This equates to average monthly job gains of just 15,000 in 2025, which is well below the previously reported 49,000 per month rate. So we are still experiencing some large revisions down in this metric, and it's something to keep in mind when you're looking at that high 130,000 print that we saw for January. Looking at private employment data from ADP's National Employment Report, this showed that we had a weak start to the year from a private payrolls standpoint, adding just 22,000 in January. This continues the slowdown that we're seeing in 2025, where 398,000 private employer jobs were added versus a 771,000 figure seen in 2024. Education and health services saw the largest increase of 74,000 jobs, while professional and business services dropped by 57,000. The smallest private employers with 1 to 19 employees, as well as mid-sized employers, saw increases, while the very largest and then the medium to small size employers saw declines. Looking at wage growth has continued to remain stable and above pre-pandemic levels, although gradually trending down over the past 4 years. Average hourly earnings of U.S. private non-farm payrolls rose by 3.7% year over year in January. This was the same rate that we saw in December's revised reading and was slightly above the market forecast of 3.6%. Month over month, average hourly earnings rose by 15 cents or 0.4% to $37.17 in January, following a downwardly revised 0.1% increase in December. This did beat the expectations, which call for a 0.3% monthly gain. And then also in January, we saw average hourly earnings of private sector production and non-supervisory employees rose by 12 cents or a 0.4% increase up to $31.95. Taking a look at initial jobless claims for the week ending January 31st, we saw an increase up to 231,000 claims from the prior week's 209,000. And as you can see from the graph here, we've been experiencing a lot of high volatility over the past several months. Looking at continuing jobless claims, this rose up to 1.84 million for the week ending January 24th from the 1.82 in the prior week. And again, similar story as seen with the initial jobless claims. We've been seeing greater volatility over the past several months for continuing claims as well. Total job openings has continued its downward trend, following by 386,000 to 6.54 million in December of 2025, and was down year over year by 966,000. This was the lowest level seen since September of 2020, and it was below the market expectations of 7.2 million. Job openings decreased for professional and business services, which was down by 257,000. Retail trade dropped by 195,000, and then finance insurance down by 120,000. By region, we saw job openings fall in the Northeast by 210,000, the South drop by 58,000, Midwest down by 18,000, and the West by 100,000. So across the board, job openings down all over the country. Total separations remained relatively unchanged at 5.3 million, with decreases in professional and business services dropping 212,000, and private educational services by 20,000. Total separations increased for transportation, warehousing, and utilities by 110,000, and then the federal government by 10,000. Taking a look at the Manufacturing Purchasing Managers Index, a reading above 50 is indicating that manufacturing is generally expanding versus a reading below 50 indicating that manufacturing is generally decreasing. The reading for January unexpectedly spiked up to 52.6, beating the market forecast of 48.5, was up from 47.9 seen in December. This was the first time in 12 months that economic activity in the manufacturing sector expanded and was the highest reading since mid 2022. Improvements were seen for new orders, which jumped up to 57.1 versus 47.4. Production at 55.9 versus 50.7. Supplier deliveries were up to 54.4 versus 50.8 reading. Employment, which is still in contraction, but increased up to 48.1 versus 44.8. And then inventories, which is also in contraction, but at 47.6 versus a previous 45.7 reading. Part of this spike can be attributed to January typically being a reorder month after the holidays. However, not usually this drastic of a change. You can see previous beginning of the year spikes. Another metric that might be impacting this is some expected price increases, again, due to some ongoing tariff uncertainty. Taking a look at retail sales, we saw retail sales remain unchanged month over month in December after a 0.6% increase in November. This fell short of market expectations, calling for a 0.4% increase. Breaking down some of the major sectors, we saw increases for building material garden equipment dealers of 1.2%, sporting goods, hobby, music instruments, and bookstores at 0.4%, gas stations up 0.3%, food and beverage stores up by 0.2%, and then non-store retailers by 0.1%. We saw declines for miscellaneous store retailers and furniture stores, both dropping by 0.9%, clothing retailers dropping by 0.7%, electronic and appliance stores dropping 0.4%, motor vehicle and parts dealers, as well as the health, down by 0.2%, food services and drinking places, as well as general merchandise stores, also dropping by 0.1%. Taking a look at the personal savings rate, we saw the personal savings rate as a share of disposable income for November coming at 3.5%, which was down from 3.7% seen in October. This marked the seventh straight month of decline seen in the personal savings rate, and now at the lowest level that we've seen in 3 years. Shifting gears, next we'll take a look at the housing market, which continues trending in the direction or favor of buyers. A recent analysis by Redfin shows that in 2025, almost two-thirds of all people buying a home were able to purchase it for less than the original listing price. Homes that sold at the list price continues to hover around a 14 to 17% range, so not much change there over time. And then that 22.8% that were sold above list price has been now at the lowest percentage share since 2019. This isn't necessarily pointing towards a booming housing market, and there are a few more metrics we'll take a look at here in a few slides, but those are certainly buyers who are actively looking to buy, especially in certain areas, are starting to see a little bit more bargaining power. Looking at buyers versus sellers in the market, for December, there was a record 47.1% more active sellers in the market versus active buyers. Obviously, the late fall and winter months aren't the most active from both the buyers and sellers perspective. However, you'll notice that that trend line is continuing to climb steeper as time is going on here. A likely contributor to more sellers than buyers is the affordability side from the home prices being very high as well as borrowing costs, which can lead to some people completely abandoning their home buying search. And obviously, high prices are continuing to incentivize sellers on listing their homes. However, they're being very intentional about their selling strategies, and we'll take a look at that in a little bit here. Here's another look at the buyers versus sellers in the market. You can see that gap continuing to widen the last year and a half. And as buyers continue to drop off, some of those sellers are starting to pull back as well. Most people would rather hang on to their, low mortgages that they got back in, the pandemic versus accepting a lower offer, leading again to some of them pulling their homes off the market completely. This is a map of the 50 highest populated metropolitan areas and shows the concentration of where there are more buyers versus sellers or more sellers versus buyers. In the red is where you're going to see that there are more sellers versus buyers, signaling again a little bit more negotiating power for those buyers in those markets. You can see those are heavily concentrated in the south, while the east, west, and midwest are still having a little bit higher concentration of buyers versus sellers in the market. So again, not necessarily pointing towards a booming housing market nationwide, but there are certainly parts of the country where buyers, again, are having a little bit more negotiating power due to some supply-demand mismatches. One thing sellers are increasingly doing is delisting their properties. In September of 2025, we saw delistings were almost 85,000 or 5.5% of total listings, which was the highest September level since 2017. As mentioned before, and many of you know, home buying and selling slows down during the winter months. So this chart is specifically looking at September data only for the given years. However, delistings have been rising since the spring of 2024, and the year-over-year growth in delistings peaked at 39% in June of 2025. As I mentioned before, sellers are being intentional about their strategy, and delistings are coming into play for them. That delisting peak that was seen in June of 2025 then saw 18% of those homes relisted within 3 months, and 20% of homes that were pulled off the market in July were also relisted within 3 months. Some sellers would rather relist their home at a lower price and reset the number of days on the market versus dropping their price on a stale listing. Of these homes that were pulled off the market in July and then relisted, 31.6% of them ended up selling. So maybe there's a little bit of strategy going on there with those delistings, and some are having success with that strategy. This is a chart showing the price discounts for buyers. So for the buyers who were able to negotiate a discount, 26.1% of them, or over 1 in 4, were able to buy it for 10% or more below the list price. 27.8% of buyers who had received a discount received a 5 to 10% off the list price. So, those two together, over half of those who did receive a discount on their home got at least a 5% discount off that list price. This chart is breaking down the average discounts received of those homes that received a discount by the property type. 2025 was the first year since 2014 where condos received larger average discounts than single family homes. Rising HOA fees and insurance costs, and in some cases, expensive special assessments, have ultimately driven down the demand for condos. Overall, 68.1% of condo buyers paid less than the list price last year, which compares to 61.7% of single family home buyers and 60.4% of townhouse buyers. This is a map of the average. I'm sorry. Sorry, I lost my place there. So this chart is showing the average discounts received of homes sold below the list price of the 50 highest populated metropolitan areas. The South, which we saw on the other map as having some of the strongest buyers markets, also saw some of the highest price discounts off list prices. And as you know, there's a lot of condos down in Florida specifically with renting or buying condos as a means to live for a lot of retired folks. Specifically, West Palm Beach, Florida had the largest average discount at 10.9%, and 87.9% of homes that were sold in West Palm Beach, Florida, were sold below list price. Taking a look at the housing starts, this data is only updated through October. However, housing starts fell to 4.6% in October from September to a seasonally adjusted annual rate of 1.25 million units. Housing with 5 or more units fell by 25.9% to 347,000, while single unit homes increased by 5.4% to 874,000. Starts fell sharply in the West by 21.9% to 243,000, with a slight decrease in the Northeast of 0.6% down to 154,000. The South saw an increase of 1.2% up to 650,000, while the Midwest increased by 0.5% up to 199,000. Moving on to existing home sales for December, existing home sales spiked 5.1% from the prior month to an annualized rate of 4.35 million. This was the largest increase in almost 2 years and reached the highest level in almost 3 years. Inventory fell by 18.1% in November to 1.18 million, which is equivalent to about 3.3 months supply at the current sales rate. Jumping quickly into the auto market, in December, we saw the average price paid for a new vehicle reach $50,326, an all-time high according to initial Kelley Blue Book estimates. This was a 1.1% increase from November and a 0.8% increase year over year. The average new vehicle MSRP also reached a record high, climbing 1.2% year over year to 52,627 in December. That marked the eighth straight month that the average new vehicle MSRP has been above 50,000. New vehicle sales declined to start the year with the seasonally adjusted annualized rate falling to approximately 14.8 million units in January. This was the lowest level since December of 2022. Cox Automotive's 2026 automotive industry outlook is currently projecting new vehicle sales of 15.8 million units in 2026. Which would lead to a decrease of 2.4% from 2025. Taking a look at used vehicles, the U.S. Manheim Used Vehicle Value Index increased by 2.4% on a month-over-month basis in January, which was the most since April of 2025. EV prices increased by 0.4% from December, while non-EV prices rose by 2.2%. And year over year, used car prices also increased by 2.4%. Next, we'll take a look at some inflation data, which did not change much in December. The annual inflation rate for December remained unchanged at 2.7% and was in line with market expectations. On a monthly basis, CPI rose by 0.3% and was in line with forecasts. The annual core inflation, which strips out food and energy, remained flat, also at 2.6%, and was below expectations, calling for a rise to 2.7%. While the monthly core CPI rose by 0.2%, which was also below expectations of a 0.3% increase. Inflation eased for energy costs up to 2.3% versus a 4.2% in November. Fuel oil was at 7.4% versus 11.3% in November, and then used cars and trucks to 1.6% versus 3.6% in November. Decreases were seen in gas prices, which decreased by 3.4% versus a 0.9% increase in November. Inflation increased for food to 3.1% versus 2.6% in November. Shelter up to 3.2% versus 3% in November. And finally, natural gas, which went up to 10.8% versus a 9.1% increase in November. Taking a look quick at the WIRP screen. Again, this is taking into account all Feds fund futures contracts being traded and then calculating the probabilities of moves by the FOMC at upcoming meetings. As of Monday, there were two cuts built in for 2026, one being around that June-July timeframe, and then another in that October to December timeframe. Yesterday, we did see a slight increase in probabilities with June and October being built in. However, as you know, this can change a lot. And then after the jobs data was released today, again, showing a relatively strong labor market paired with some inflation continuing to run above that 2% target. We did see a pullback to below where we were at Monday, but again, still looking at 2% or two cuts being calculated in by year end. Shifting gears, we'll take a look at the yield curve on a month-over-month basis. Not much change month over month besides the front end of the curve. We saw the 1 and 3 month part of the curve up by 10 and 8 basis points. The 2 year was down by 5 basis points, while the 10 to 30 year part of the curve was up 5 to 6 basis points. Looking at year over year, we did see obviously greater volatility or greater changes on a year over year basis. The 1 to 3 month part of the curve was down from 62 to 63 basis points, while the 1 to 5 year part of the curve was down roughly 70 to 80 basis points. The 30 year is relatively unchanged year over year, down by just 5 basis points. Taking a look at some market rates, the 2 year Treasury has seen some moderate volatility recently, sitting now at about 348. The 10 year has been tracking up the past several months after bottoming out below 4% in October. It's since climbed back up to around 422. Silver's been hovering around 364 since we saw the last cut at the end of last year. 1 month term SOFR sitting at 367 again since that last rate cut in the end of the last year. 30-day average SOFR again around that 366 mark, while 3 month term SOFR again around 364. 90-day average SOFR is continuing to track down lower, again, as those rate cuts from last year are continuing to factor into the average. So we're not quite down to the lowest level yet, building in all of those rate cuts. We're down to about 379 as of Monday. Finally, taking a look at the MBA refinance index, we've seen some strong spikes recently with MBA refinance index here as mortgage rates have been declining since last fall. Obviously, with the lower mortgage rates, that's been allowing borrowers to refinance and take advantage of some lower rates. So that's all I have for you today. I'm going to go ahead and check the chat here, see if we have any questions. Obviously, if any questions come up after the fact here, you can always reach out to me or anyone in the investments department. Taking a look here, I don't see any chats or questions out there. So I want to thank everyone for their time and hope to see you again next month.